Woo, baby! Today, we gotta talk about them TikTokers, and we gotta set the narrative straight here. I've been hearing so much about people like Elon Musk exercising options rights, Chamath Palihapitiya selling off some capital to kind of diversify, and heck, even Warren Buffett having more cash than he usually has, and people are directly saying, because of this, and because of hyperinflation, these two things paired together mean the markets are eventually going to tank, and this is like the stupidest thing I've ever heard. When there is hyperinflation, that means the products and cost of living go up drastically. Therefore, people do not want cash. They want investments because investments help them restore the value of their dollars. I mean, this is like some common sense stuff when you've had experience in the market, but to newbies, we're going to be breaking this down a little bit farther because we just had the Fed talk, and it gets really confusing when we're talking about transitory stuff and interest rates going up. So I'm going to clarify this in a way that'll hopefully simplify it for you guys. So if you appreciate that, consider hitting that like button, because first and foremost, let's just take a look at the market. Look at Apple after being up almost 3% yesterday, down 5% today. Microsoft getting hit, just all your tech stocks. I mean, Tesla, Tesla's hitting new lows it hasn't seen in a little while here, and so I maybe picking up opportunity. Let's not talk about what we're buying here just yet. Let's just take a look at the other half of the portfolio, because luckily having some decent risk tolerance, being globally diversified, protects me against the volatility in the market, and that is proving stabilizing in my portfolio today, because some of my consumer discretionary is doing great. Probably J&J, some pharmaceuticals doing good because of obviously the new pandemic fears. But take a look at this. All my Canadian banks holding roughly toward their all-time highs, huge positions in my portfolio. My REIT's doing relatively good here, guys. My utilities were doing great today. My telecom was doing so. That half of the portfolio is definitely sustaining this drop in tech today, which I'll be revealing more when we take a deeper look into my portfolio tomorrow. But honestly, guys, this is still not a good time to be a risk-on investor, especially when you're looking at these heavily risky companies. Look at Coinbase, down almost 5%. The ARK ETF, probably because of Tesla, just tanking. The Genomic ETF down almost 5%. Hyliion down 3.2%. I mean, it just goes on and on and on. But let's talk about why you can't really predict what's going on here. Right before the Fed talked yesterday, the markets pulled back like a little bit more massively than shown in this chart. I wish it would actually show what happened, because literally before the Fed spoke, there's a huge spike down, followed by like this massive run up into close, right? Like a huge run up in the S&P 500. And now we're pulling back again today, and this was really unpredictable for most investors out there. And I mean, it was almost kind of a similar story, not so similar story, I guess, coming from the S&P TSX. I mean, this is the Canadian side of the border, guys, and when you just look at these charts, it's like the volatility is starting to build back up, right? But look at how similar that is. It's kind of the same, but not the same, right? When the Fed came out and talked yesterday, the markets were tanking down, and then this massive fly up. And I don't know how the US markets correlate so justifyingly to the Canadian markets, but for some reason they correlate even with US news that doesn't exactly affect Canada. But let's talk about Canada and the US, more particularly around interest rates and hyperinflation here, and where I see the markets generally going over the next 6 to 12 months. Now, when we're talking 6 to 12 months, we're going to be looking at a few secular microeconomic things. We're going to talk a little bit about real estate here, and we're going to talk a little bit about the stock market in and of itself, because in the next, I'm going to say 3 to 6 months here, guys, the Federal Reserve, I mean, if you haven't heard about it, they're literally being as transparent as possible. There was no rug pulling. They said that they're going to be raising interest rates after they begin to tamper off the bond purchases. So we're going to see interest rate hikes probably toward the end of the first quarter, early second quarter, which means that we still have this wonderful window that we're sitting in where hyperinflation is still running rampant. Supply chain shortages are still insane. We have this new pandemic fear, guys, and we still have record low interest rates. What does this mean for the market? Choo-choo, plug it in. Let's go, baby. All-time highs, get to the moon. The rocket ship should continue, in my humble opinion, at least until early next year. And what is going to come after that? Well, it's going to get dicey, because here in Canada as well, they're going to be raising interest rates probably for the first year, not much more than 1%, but going into 2023, it's likely we're going to start seeing percentages of heights in the interest rate market for the first time in a decade. Now, what does that mean for the market? Any heavily leveraged company that is utilizing debt, whether we're talking REITs, utilities, I could see them being a little bit more hindered if it hasn't been priced in yet to those stocks, which again, they're trading down. A lot of utilities, anything that's heavily leveraged is usually trading down, and I can only presume based off this news, but where things are really going to start to get cushioned is real estate. People right now are going to continue to fetch up any low interest rate, lock in 5, 10, 15-year mortgages at the lowest rates they can get, because they're going to start going up. And typically every 1% interest goes up, real estate comes down 10%. And because they're doing this so methodically, I wouldn't be surprised if all of a sudden we see it cool down and a slowdown in the real estate prices or the price market. And the only reason that makes sense, guys, is because the current price, the price growth is completely unsustainable. I mean, real estate's trading up almost 80% this year, depending on where you live within, anywhere around the major cities of Toronto, Vancouver. You have made a bloody fortune in this market. And that is not something that I'm telling you is going to continue, because if it does, that means hyperinflation has run completely rampant. We are going to see mass poverty going across the entire nation, the devaluing of currencies, and things that will just not make sense. So do not expect real estate to have a crazy run up moving forward. But let's talk about the stock market in and of itself, guys. So the stock market, my opinion, guys, things should be just dandy for the next few months. But as we move into this other half of the year here, or into mid of 2022, interest rates go up. I think we're going to see some secular fluctuations, but where things will get really impressive, and I think this is where people's minds will be absolutely blown, is when, and I don't know when this will be, because obviously we still have pandemic fears, we're still locking down in countries again, we're still kind of heading into this new wave almost. And what this is going to do is continue the supply constraint shortages. So companies that don't have to deal with that, my favorite companies like Facebook, like Google, like Apple, that have paired very well in this environment, I think they're going to continue to. But once we get to the other side of this, which I would more predict to be toward the end of 2022, early 2023, is when the market is going to go through a second period of an explosion. Because what people seem to forget is that these companies are doing this well. I mean, we're talking about revenues and earnings, not the stock price. Revenues and earnings are doing this well in a market where people can't even get supplies, chips, all these chip shortages. I mean, look at GM, Ford, these companies that are doing so well, even though they're having a hard time delivering products. Imagine what these companies will look like. Imagine what Tesla's going to look like when they can actually meet the full scope of their demand. Again, most car sales for them are pushing out till 2023. So I really feel like the next year will be a little bit rocky, but once we get through that, guys, it is a clear sky, so long as there's no black swan events or this pandemic doesn't take a twist, which, being frank, even if the pandemic does take a twist for the worst, we still pair out doing just fine, because everything we hold has been positioned through the pandemic. All of these pandemic plays, Facebook advertising at home, computer parts, gaming, Microsoft, Apple, healthcare, Johnson & Johnson, consumer stapled brands that continue to do well through these crises, right? And now that the real estate market's so hot, most of my REITs have a lot of liquidity, and I feel like I'm positioned very well for this. So these are my opinions. I passed the question off to you. What do you guys think about this market? And hopefully you're able to wrap your head around it, because we are definitely in one of the most confusing times to be investing, especially considering good small cap companies continue to downtrend. But let me know what you think. Stay cool, stay awesome, and I look forward to catching you tomorrow.